Welcome to the Real Estate and Wealth Podcast, your go-to resource for navigating the world of real estate investing and wealth creation. This podcast is brought to you by Calvert Home Mortgage Investment Corporation, your trusted, caring, and responsive short-term mortgage lender in Alberta and Ontario. We explore strategic and tactical solutions to elevate your real estate portfolio, drawing insights from seasoned Canadian investors and trusted advisors. In each episode, we dive into various aspects of real estate investing, including market trends, property analysis, financing strategies, risk management, and much more. Whether you're a seasoned real estate investor looking to expand your portfolio or a beginner taking those first steps, this podcast is for you. Today on the podcast, we have Eric Poblete, super excited from Equifax, willing to share his knowledge. I got myself, Ryan Day, and Rob Maber from Calvert Home Mortgage. Welcome, everyone. Super excited for our conversation today, as I know credit's obviously a major focal point for real estate investors. But Eric, why don't you tell us a little bit about yourself?
Oh, goodness. I didn't expect to do the bio there. Eric Poblete. I've been actually with Equifax for 13 years now. Essentially a professional sales rep across the board, done all different technologies. But certainly today, my focus, or these days, my focus is really working with a lot of the mortgage brokers across Canada. And the biggest focus is really about education. Knowledge is power. That's the reality of the world today. So the more you know, be it as a real estate agent, an investor, or what be the case, the more successful you will be. So that's really the biggest job I have. Even though I'm a salesperson, absolutely out there to help educate your customers as well as all the brokers in Canada.
Perfect. And just so our audience is crystal clear, you're speaking on behalf of you and yourself only. The views expressed within this podcast do not reflect those of Equifax or its affiliates. This is just Rob, Eric, and Ryan having a conversation on credit, correct?
And I appreciate that, Ryan and Rob, just because you know what? I don't want to see $1 million bill in my invoice sometime soon. Somebody saying they made a decision per se. Absolutely, though, I can absolutely provide all the guidance from Equifax because a lot of the information I'm going to provide is public knowledge. It's information that Equifax actually does put out. And actually, as a precursor to this conversation, both of you reached out to me because you were looking for what information Equifax had. So I will preface this by saying Equifax.ca, we've recently have been continuing to increase the information we have for our customers, for our consumer customers, and a lot of great information. So you're going to hear a lot of information today that comes from that website, as well as a lot of the webinars that we're doing as well. Beyond yours, Equifax actually has our own webinars quarterly, which really provides updates for really the whole industry itself.
Perfect.
Awesome. Fantastic. If you're able to take us back, how did the whole credit industry and credit landscape start? If you're able to give an overview, as I'm personally very interested in understanding how credit came to be and Canadians' fascination with credit.
Well, interestingly, the history of Equifax per se is well over 100 years old, whether you knew that or not. It actually started in 1899. There's two brothers, name of, I think, Cater and Guy Wolford, and they started in Atlanta. And what these gentlemen did, they had the foresight to literally go door to door to all the businesses in the neighborhood in Atlanta and started collecting information on customers. So it was a very, very manual process. But really what they did was they got all that information consolidated, then sold it back to the businesses, very much like you would see in Equifax today, but really at a small level. So it goes back that far. And it continued to grow. I think in the 1920s, they expanded into Canada and the US. But they continued to grow. I think the name of the company was Retail Credit Company was really the original name of Equifax way back then. But they continued to grow since that time period. I'm not going to get into all the other details, but some of the more significant changes is probably as they evolved into 1970, when data became computerized.
Right.
That's when the government actually jumped in. So in the U.S. especially, they actually created a what they called the Fair Credit Trading or Reporting Act in the U.S. because the information that they were collecting, how can I put this, got a little personal.
Right.
They started getting into stuff that, even today we wouldn't accept. Sex, this, how many children you had, all the really sensitive stuff. They actually had all that. But the U.S. had the Fair Reporting Act, which changed things over in 1970. But since then, it's a continual growth because I've joked with other people, that whole cliche, death and taxes. Well, I
Yeah.
always add one more: death, taxes, and credit. But
You
today, from an
would.
Equifax perspective, we're in about we have about 11,000 employees worldwide now, about 12 billion in assets, and we're in 25 countries. So we're a little jaded because we see credit today in Canada, the U.S., but you are going to be quite surprised that it's not everywhere in the world. It's not like you've got the 200 countries in the world all doing credit. So, where it is available and where there's actual credit, Equifax is certainly a significant player, mostly in Europe, South America, and in Canada type of, or North America. Those are really the bigger hubs, but we're still continuing to grow. So, from two brothers walking door to door to, billion-dollar company, that's where we sit today.
Perfect. So two brothers knocking door to door. Who is this person? What do they
Yeah.
like? Do they pay their bills on time? Those types of
Excellent.
things.
What are they buying? How much are they buying? Are they
What are they
rich?
paying? How much? When do you get your money back, etc. Fair Trading
Exactly.
Act or the Fair Credit Act. Forget the exact vernacular that you used.
Fair Credit Reporting Act. Yeah,
Fair
that
Credit
formalizes
Reporting
the
Act.
whole
Thank
thing.
you. What kind of data is Equifax tracking today, though? So, say you pulled my credit report. I know the score, 858.
Yeah.
But what would be on that credit report, and what are some of the objective data points that Equifax collects from
Yeah.
Flex?
Yeah. And you know what? You hit the nail on the head very specifically is what we call objective data. And that's really the key item. So what we do from an Equifax perspective is we work with many of the different providers in Canada that essentially lend money out in one way, shape, or form or another. Credit cards, auto, property rental, things of that nature. We actually have them all as what we call contributors to Equifax. So essentially, we get all the main information financially related, which is, how much are you paying? How much do you have outstanding? What's your high limits? Things of that nature. And then on top of all that, it's also the reporting of how well do you pay? Are you paying on time? Are you a late payer? What be the case? Over and above that, outside of that, we also have some traditional information we collect, which is the fairly standard, to identify an individual: name, address, date of birth, phone numbers, where you last lived, and so forth. So that helps to consolidate the identity of the information of that individual. And then lastly, the other key component of information we provide or we receive is a lot of the government information, mostly public knowledge, bankruptcies, divorces, things of that nature, which are also included on the credit file itself. So that's really the raw data itself. And some of those components are the ones that then go into, and these are the objective components that then go into, when we get into later discussions about scores itself. Because then you factor in all those different items and you put it into the score, all the relevant items, of course. Where you live does not necessarily reflect your score, but certainly how you pay your bills will reflect on the score itself.
Right.
So, end of the day, all these entities report to Equifax millions of bits of information every day on the millions of 30 odd million Canadians. We consolidate all that raw data and then we basically put it back together to customers like yourselves, real estate agents, brokers, and so forth, so that they can make the judgments and calls in regards to working with a consumer.
Yeah.
Because sad as maybe, consumers don't always have a great memory of everything they've been doing the last 5 or 10 years.
Well, that
So
third
we want
mortgage
to
on
be,
my house. What are you talking about?
that's
it.
So
That
we
car
want to be
loan.
objective,
Forgot
and
about
we're doing
that.
it in a polite way, but we provide you all the information accordingly. Because at the end of the day, you really want to make sure people get exactly what they should be getting. If you can't afford a 5 bedroom house, let the numbers say what they do. I kind of joke with people. It's like, you dig the hole that you're in and then you live in it. That's really the animal, but certainly it's objective, and that's really the key thing from the data that we have.
I,
So
lo- I
yeah,
love what you said there. Like, from the underwriting standpoint, it's an identity verification tool. We're seeing if there's any aliases, an AKA with married names or change names and whatnot.
yeah,
Today, people can change more than just their name. We're using it to confirm other pieces of ID, such as name, date of birth, addresses, previous addresses, to mitigate fraud. And then within that, you referred to them, I think, as lenders and creditors, as contributors to Equifax. The
absolutely,
verbiage that I'd be more familiar with is, do you report to a credit reporting agency? So what type of debt do people have? What is it revolving? Is it installment? Is it credit? Is it a mortgage? How long have they had that debt for? What do those monthly payments look like? What is the probability of you being repaid is what it ultimately boils down to. And how often is
absolutely.
this person searching for credit? And how do all of those data points, plus a few more, contribute towards your willingness to extend further credit to this person? It's
Yeah.
a phenomenal tool. And what I
Yeah,
really
and
love,
remember though, these are as best as possible. These are what we call predictive analytical models. So is it 100% accurate? Not necessarily, but if you have enough data, you can create a model that really says the likelihood of somebody who will a pay on time, have enough to do, or what be the case. Because it's always a challenge. Sometimes, like my father-in-law, he's good old school Italian. He's got all the money hidden under his mattress, but his credit is really crappy because he has
right.
no credit per se. So really overall, it's a predictive model based on traditional items, but certainly, there's always nuances around that type of scenario.
Yeah. And just to add a little bit more context to what Eric just said, a FICO score or credit score, 3 to 900, the higher to 900 you are, the better your score is, the more confidence lenders are going to have in them being repaid. Anything below 600 is going to be a little bit more challenging to obtain financing. Anything above 620, 640 is generally viewed to be a bankable A client. There's a ton of other things, such as income and type of property, that can dictate the type of mortgage that people can be eligible for. But purely from a credit standpoint, the higher the score, higher the probability that you're going to be repaid. 3 to 900, you want to be closer to that 9 to that 3. If you're sub
Yeah.
6, there's probably some remediation in terms of credit that should occur.
Oh, and absolutely. The higher the score, I mean, I typically tell this, and even to my children, the higher scores you have, the more benefits you get, the
Yep.
more options you get. You have the chance to get better houses, less interest rates, and you get preferred. You basically get preferred treatment based on your credit score. And the lower, unfortunately, you start to cut back on a lot of your options.
Less
They're
options.
still
Yeah.
available, but
Yeah.
certainly you might be paying for some of those options.
You got to match risk with the cost. Um, and what I love about what Equifax does, and people like yourself, you're looking at overall credit trends. You have your secured lenders, which can be homes, trailers, boats, RVs. Then you have
Yeah.
unsecured. What kind of trends does Equifax monitor in the credit space, and why are they important?
Yeah. So beyond the credit file itself, the other services that Equifax provides is really a lot of analytical information to our consumer or to our customers, such as the banks or credit card companies and things of that nature. So they actually look to us for over and above just the credit file itself. What predictive, I guess, trends, as you mentioned it, can we see? Is there a trending towards people spending more money on their credit card, or is there a trending towards people more going towards bankruptcy? What are you seeing? So, from the basic objective data that we have, we can start to actually provide to our customers, this is what it's looking like. That in the next quarter or next, 6 months to 12 months, we're looking at, for example, unfortunately, recently, when we look at consumer debt, we've seen the upward trends, and we actually can measure that because we do have a lot of the data across Canada. So, if I want an actual number, the recent trend is we're up to $2.45 trillion in consumer debt with mortgage and without mortgage. But again, the information, it's good raw data, but beyond that, this helps our customers to make the decision of, okay, if I'm a lender, do I decrease my risk or do I increase my risk? Do I look for higher scores or lower scores? We start to set up, with the raw data, we sort of give the information for lenders, credit card companies, even auto dealers, guidelines as to what should they do, because very much the same as anybody else, they want to increase their sales,
Right.
but they don't want to increase their risk. So that, all that information gives a balancing of what's going on. And again, it's across Canada. Why is that important? Because you know what? If it's a one-off person, well, maybe not so much. But if you want to set your sales strategy, you really have to know what's going on across Canada. Should I be selling more in Quebec? Should I be setting, different priorities in Vancouver? Maybe because the housing is so high in Vancouver, I have to decrease the cost of cars. So there's a lot of moving pieces, but Equifax provides that raw data in many different formats to many of our customers so that they can see those trends and then, decide on what they're going to do and how they're going to market their services and business.
Perfect.
And that 2 trillion in debt, how would that fare versus say 5 years ago?
So I'll be quite honest with you, I don't have it completely trending, but I mean, I had the last 2 or 3 years, and I believe we broke the 2 trillion mark probably around 3 years ago. And it's hard to fathom trillion. I mean, that's a huge, huge number, but certainly it's increasing. And the predicament we have is, as everybody's seen, interest rates have gone up over recent timelines. Only recently we've seen them start to decrease. That's going to be a generational thing, okay? Because I know of a lot of individuals out there who have never seen, double digit interest rates. They're younger, but certainly, my parents have saw it. My parents bought a house when they were paying 22%, like just like a credit card. It's like you buy a house on a credit card. But the younger generation haven't seen that. So they're getting used to money, to be very honest with you. And the fact is, because they're not used to money, you know, the debts are increasing because it's, a concept of, oh, it's free money. I'll do fine. You know what? There's always money downstream or down the road. My house price is increasing, and as such, I'll always have a nest egg to be able to pull money from. A lot of those concepts are not the old savers mindset that my parents had. So to that degree, that's why we are starting to see more and more of the increase. Then again, layer onto that the higher interest rates. What does that mean? If somebody had a house and they bought recently, well, guess what? If you've doubled your interest rate from pre-COVID to now, let's say you were paying 2% to 5%, you're now paying maybe $1,000 to $1,500, depending on the size of your mortgage. So all of these things are all starting to contribute overall to the health of an individual. Because remember, the money is not specifically earmarked just for mortgage or earmarked just for credit cards. It's your net wealth. It's your net money that you have coming in and going out. And so to that degree, the unfortunate scenario when we talk about credit cards, they take the brunt of it. If you can't pay anything in Canada, the cards will take the brunt of it. Houses, mortgages always get paid. Fortunately, we have a very low bankruptcy rate, but the credit cards are where you're going to take the hit in regards to the increase or the higher numbers.
And that's kind of the one thing that I wanted to hit on. I mean, a lot of gold in what you just dropped there. And I'd love to comment on the boomer 22% mortgage. Yeah, your income to house multiplier was 2.5. Now it's 6. So that's a whole different story. But you talked about leading indicators of data, and you talked about which creditors generally don't get repaid first or who gets paid in priority, basically secured lenders. So with so let's talk about that a little bit for our listeners. So in the many data points that Equifax mines and reports back to its customers, when you're gauging the predictive health of an economy, what are some of the what are some signals of potential stress, and what is Equifax seeing today?
So I think one of the terms they call it, the bellwether or leading indicators.
Yeah.
So typically the leading indicators is really credit cards.
Yep.
So credit cards is always the first, unfortunately, gets either delinquent and or they change their payment habits and so forth. So if it's on one side of the world is the credit cards, on the other side of the world is really mortgages and housing. And I will tell you for a fact in Canada, because it's just the way Canadians are. We have Canadians that'll get a second job, a third job. They'll make their kids work slave labor. I don't know, but they'll always make their mortgage payment. But on the credit card side, that's where we're starting to see the leading changes. So, for example, recently, when we looked at the last analytics in regards to credit cards, we saw 1.3 million Canadians actually missed their last payment in regards to credit cards itself, like missed it altogether. And that's significantly increased. And then the other trend that we're starting to see is the balances are also starting to increase as well. So we're seeing the banks, and it's unfortunate, but it's reality. The banks will take advantage of that. Great if this person's not too bad, they're paying. But if we can increase how much interest they pay us, we're happy with that. So they're selectively working their way through all that. But at the same time, net is we're reaching a very high consumer debt. That people start to measure, your debt ratio as compared to your house and so forth. Canada is one of the worst in the world. But at the same time, interestingly, because of our conservative nature, we will continue to pay that. Is there a breaking point? I'll be honest, this is where the opinion comes in. I'm not really sure. As long as the house prices were always increasing, everybody was able to use their houses a little bit like a piggy bank or a little safety net. But when house prices flattened out, it became come to Jesus type scenario of, can we really afford this?
Yeah.
If things flattened out, are we really good? So that's really what's happened is, if we had actually stayed in a decline of, and this is opinion again, and they continued and they did not decrease the interest rates, I think we would have got a fairly significant amount of bankruptcies starting to evolve because people would have been distressed. They would have just had enough and be done with it. But interestingly, as now we're starting to evolve back into the next possible surge, I think it might save a lot of people. The investors out there who had houses that were saying, oh my gosh, do I sell off? Do I hold off? They're right now on the fence of deciding, do I sell up all my extra properties or do we hold off because there's a next surge coming up? That's a $64,000 question. I can't say how quickly it's going to recover, But really, it's a bit of a bluffing game between buyers and sellers right now.
Who
The
knows?
buyers are waiting it out a little bit more. The sellers are saying, no, you got to buy it. My opinion, if you do the math, you should be buying. If you're somebody who's out there looking for a house, because the interest rate differential that you're looking for, that next quarter point, it's not going to make up for basically the the rise in house prices that I expect in the very near future.
No,
And
and I mean,
reality, it's a
yeah.
supply demand. We don't have enough houses. I
No,
mean, it's
exactly.
got to go.
It's a scarce resource. It's not like we're talking about trading a bond where everybody has access to perfect information on a trading platform and you're buying at a present value that's going to produce your desired yield. Your people are transacting with different access to information, intelligence,
Yep.
education, and motivations. So it's going to produce a wider, it's an imperfect good, an
You know what? You
inefficient
say
good,
motivation. That's also the scary part. I think there's a lot of emotion in the industry.
and emotion. 100%.
That's the
Yes.
bigger animal. And I try
Stated
to
differently,
present positivity, but it's all about emotion. I think when people are buying and selling.
Um, the one thing that you talked about, which I thought was really interesting, and I like these reports context. I'm a reader and a fan. The value of those insolvencies is going up,
Yeah.
which is really interesting. And I liked how you talked about too. People aren't going to lose their house; they're fine to walk away, or not walk away, but let the credit card run up a little bit, but they're going to pay their mortgage. Um,
Yeah.
yeah, like
You
what are
know what?
some?
If I can pause you on that though, I will say one trend that has been coming up is really what we call the surprise bankruptcies and insolvencies. So it's an evolution that's occurred over the last 5, 10 years in Canada. So in the older days, if you have experienced reps out there, you could actually see when somebody was not doing too well. You could actually see them decline slowly to the point of you knew that was going to happen.
Right.
But in today's age, what's going on a lot more so is people are using one resource to pay another. The old term kiting. Some people say give from Peter to get from Paul. So somebody's paying his line of credit to pay his credit card, who then pays his mortgage with his credit card. They're moving their money around. But what ends up happening is we find that now in today's environment, bankruptcies occur very, very quickly. So somebody could actually be holding a very good credit score, 680, 700, but then within a 90-day period, they essentially tap out. They basically said, you know what? I can't do this anymore. I keep paying everything off of each other, and they then go bankrupt within 90 days. So that's one of the trends that we really have to keep an eye out for. Our lenders have to keep an eye out for is people who are starting to show a little bit of that rust on the side. They have to be ready because there might be a potential that they might just, give up, tap out, and move on. Claim bankruptcy or go into insolvency very quickly. So that's one of the trends when we talk about trends. It has been occurring over the last 5 or 10 years. Not easy to predict when that person goes bankrupt.
That was my next question going to be like, has Equifax or have you observed any correlations between this surprise bankruptcy and that? Because like, okay, you're going to see rising balances, one,
Yeah,
one,
yeah.
one, 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 and then it's going to go two, three, four, five, nines. Like it's going to go into
Yeah, so
collections.
yeah, so we've actually created tools, not recently, but probably last 10 years. We call it a bankruptcy score, which is not a credit score, but actually a different type of score
Yep.
that measures other parts of your portfolio. Your wherewithal to pay because it's a different scenario. So those scores, and some of the banks have them, the lenders or the mortgage brokers actually have it available on their credit file. It measures the likelihood of somebody to go bankrupt in the next 90 days. And it scores a little differently from 0 to 1,000, but really it's a different type of flag. It's a different indicator. So we've had to create scores for that sort of scenario where just looking at a FICO score is insufficient for you to really look at the long-term health of an individual. So, we again continue to improve from Equifax, provide more information and data, more analytical models, but certainly, it still becomes the judgment of the individual, the lending institution to decide what kind of risk that they're going to take, even against the odds of some of these scores and so forth. Because again, based on the emotion that Canadians will pay and based on the recent history that housing pricing continues to increase, yeah, there's a lot more people out there taking more risks from a lender perspective, only because they know that they're going to be able to cover themselves.
Yeah,
Right.
definitely. Are there any new additional data sets that Equifax is looking to start reporting on in the future?
I think you mentioned or you asked me about this, and certainly we love more data because at the end of the day, what we want to do is represent an individual, Ryan or Rob, as who you really are. It's not about how you pay some of your bills. We'd love to have a full, comprehensive package of how you pay all your bills. Things that aren't on there right now, such as utilities, such as possibly rental. We would love to have all that included because that really composes of an individual in their totality, as opposed to, just all the traditional. And I will tell you, it's going to be interesting in the very near future because if you know the younger generation today, they don't have traditional data sets. What do I mean by that? My nieces and nephews, they rent. And today rental is not specifically part of the credit file. They Uber everywhere. They're not buying a car.
Right.
Credit cards, they don't necessarily get a credit card. So the old school of how you usually measured somebody and how you'd give them a credit score or rating, a lot of that's going away. So you have to start to look at other alternative methods of getting data. You've heard the terms open banking, where they look into your bank account. You're looking at all different trending reports. You're even looking at self-serve, where people actually self-report information. And even some of the industries are also starting to look at rental reporting. So keep in mind, Equifax wants to get this data. The challenge becomes just more the logistics of that. And a classic example is rental.
Yeah.
Absolutely. I think it was just mentioned earlier this year, Trudeau was saying, hey, I want rental. It's great for the government to say so, but for us to logistically do it is a challenge. But we want to do it.
And
So go ahead.
and that was the first thing that jumped out at me. They said, well, these in theory, yes, it would be a great piece of data to collect, because if you've been a good payer of rent for many years, yes, your credit score should be reflective of that, because you have demonstrated an ability to repay over time. Okay, yes. How does that happen though? Most landlords are your mom and pop landlord who own one or two properties. Are we going to burden them with a reporting requirement to Equifax? No. Okay. Is it a self-reporting mechanism? Okay. How does that look? How does that translate to a data integrity standpoint? And then the usability of that data. It's
So you're actually pointing out all the logistics, and that's all the challenges I've been dealing with I've been on the hunt for rental data for 5 years now. It is a challenge, but certainly, and I don't want to speak over my president, but if you go to Equifax.ca, our president speaks a lot about her goal in regards to what we call the credit invisible. People that have credit that they should be reporting, but how do we get that so that it becomes part of the, discussion when they're looking for additional things such as houses and so forth? Because again, if I had somebody paying rent for 20 years perfectly, sometimes paying $3,000 or $4,000, I would love to lend them money to buy a house. Like, I mean, it would just be so perfect. But how do you get them to that level? So absolutely, as I mentioned, in Equifax.ca, if you want to see more on that, it's a touchy subject, but certainly, our ultimate goal is getting more information, as per what Ryan was asking. We absolutely want more data. It's just a matter of making sure it's substantial and that it's accurate. And that's really one of the key things. As you mentioned, do we trust, tens of thousands of landlords to provide accurate information? That's a challenge.
Yeah, it is a challenge, and it's not even a touchy subject. Like it shouldn't be. Like we're talking about a report that is objective in nature, that is in black and white in numbers.
Yep.
So I get why it's a really polarizing topic for some, but at the end of the day, it's like, listen, we're only as good as the data that we work with.
Well, we were actually on the verge of trying to make some good headwinds, but then COVID happened. And then that threw everything out the window, because then were people paying their rent? They weren't paying it. The government was assisting them. There was a lot of moving pieces at that point in time. And again, people love it if it helps them. But if I'm not paying my rent because of certain situations, they don't want it reported.
Yeah.
So you got to look at all the plus and minuses. We want to be objective, but at the same time, there's also a lot of, public and political pressures in regards to some of these things. And that's it. It ideally sounds wonderful, but when you get into it, it's okay. Let's weigh in all the plus and minuses and all the people's perspective of this.
It's tough to execute. And as an alternative lender, one of the things that we see, I wouldn't say common, but it's not uncommon to see a reject credit score. We are really concerned about seeing that demonstrated ability to pay. So then we'll kind of look at things and say, okay, send me your lease agreement and send me 6 months bank statement so I can see that you've had the money to pay that over 6 months. And then I can document a case to the file. Hey, this is a new permanent resident to Canada. They have a cash, card, and they have an NMAX bill, and they've paid their rental bill. But sometimes that doesn't always translate to a score. Should it? Yeah, on the other hand, that credit score could damage a lot of potential tenants too if they're non-payers. And what are the consequences of that? When
you get into data, you actually also touch on a point which is also becoming in vogue, which is open banking. And I mentioned it earlier. And open banking is really the concept where you as a consumer let a lender or let somebody look at your basically your bank accounts, give them access to it in some manner, safe and secure, so that you can actually, say, hey, you got $5,000 money coming in every month and you're only spending 2,000. You've got 3,000 spare. You know what? You might be a good candidate type scenario. But the
Right.
challenge around open banking in Canada, even though it's happening in Australia and some in the US, is getting all the players to play. Open banking is wonderful, but it's even better if all the banks actually participate together. So if you ever tried to get all the banks sit in a room together, that's quite the challenge. And then if you ever have to ask all the banks, oh, can we all share all your data together?
Yeah.
Well, that's the big challenge in Canada is open banking is a wonderful concept, but right now it's really individually, one by one individuals doing it as opposed to a whole network and system, which would be the most ideal.
Mhm.
So how do we get to that is another challenge for Equifax.
Yeah.
Geez, lots on the go. Oh my
Lots.
God. Are
Well,
there any misconceptions or myths that you typically see on a daily basis as it relates to credit?
Yeah, oh, absolutely. I mean, and we could get into, and we get into a little bit of minutia, but certainly from a credit perspective, I mean, some of the key myths that are out there is really, people always worry about how much money they have and so forth. Keep in mind from a credit perspective, I don't want to say it's a game, but it's almost like a game. It's not how much money you have, it's more how you manage your money. And that's what will reflect in regards to, when we talk about ultimately credit scores. So you could have $1 million line of credit, but you can go both ways. You can have a terrible score or a good score, depending on how you manage that. So from a perspective of, I'm going to say breaking some of the myths, but maybe even just educating some of the people, there's really two or three key things that people should be aware of when they're working with their credit. One is, and I will say this, with all sincerity, you know, and with a little bit of humility, first and foremost, try to make sure your credit file is accurate.
okay.
It's a challenge. We're dealing with 30 million Canadians, and if nobody moved and nobody ever changed their phone numbers and nobody got married and changed their names, it'd be a better system. But the problem is everybody moves around and changes their name. If somebody's buying you working their credit and his name's Jonathan something, Jonathan Smith, then he calls himself John Smith, then Jack Smith, and then he moves and then he gets a new cell phone. We have to pull all that together and say this is the one entity, and this is a good thing about Canada. We don't ask for your social insurance number, but because of that, we have to find a way to craft that together. So, one myth, be it right or wrong, is you have to be looking at your credit file first and foremost, make sure it's accurate. The other myth that's out there is, a lot of people get so gung-ho and concerned about, credit files being pulled. So I just want everybody to be aware that, we call them hard inquiries. And the reason that people are so gung-ho and concerned about that is it probably was a few brokers out there that made it hard, or even banks that made it hard for people to switch around. And they said, oh, you work with me, you can't go anywhere else because you go anywhere else, you're going to ruin your credit score. I think that was a myth that's out there. But in the reality, when you look at the credit score itself, inquiries themselves only account for 10% of the score. And over and above that, the models that we work in the mortgage space, they actually take all those inquiries and treat it as one event overall. So really, when we're working with consumers, unfortunately, they got to remember that the two missed payments they had on other things are much more significant than the actual pulling of that credit file. But, it's always easy for them to blame somebody else. They don't want to blame themselves for missing payments or being a high utilization. They'd rather blame the system and say, hey, because you pulled my file, you killed my score. When in most cases, it's almost impossible for the credit inquiry to really hurt your score that much. So that's really one of the animals that's out there. And then the last myth is as well is, and a little bit of a do better is in regards to what we call utilization.
Yep.
So most people think, okay, if I pay all my bills on time, I should have the best score in the world. That's the way the model works. But utilization, and I've called it the silent killer, can really hurt you because that then starts to impact, and it accounts for about 30% of the weighting of your score. That can start to impact you negatively when you have too high a carryover. And let me give you an example. If I've got a $5,000 credit card, but I carry 4,500, month to month, let's say 90%, your score could be dropped by about 100 to 150 points, even if you're paying all your bills on time. So what we have to advise people is always keep your utilization low. What's low? Depending on your lender, 30%, maybe lower, but definitely keep it lower because all we can tell you is at the higher levels, it can significantly impact your score, even if you're paying all your bills. So keep that in mind as
Interesting.
far as
I mean, and that's timely that you bring that up, Eric, because I'm working with an applicant right now, all ones. M1, R1, C1, O1. But he's hammered on utilization because he maxes out his cards every month and then he pays it all off. And he sent it to me. And I said, listen, based off of when this reported last and when we pulled the credit report, your score starts with a 5. But I look at the score and I go, yeah, I see that, you sent me this, but this isn't good enough. Like, we also have a policy that we have to adhere to as well. So
and some lenders actually have
will hammer you.
Yeah, and lenders will have some lenders will have a criteria that if you're over a certain percentage, 30 or 40, they won't even look at you. So be conscientious that it's not just about paying on time, but also keeping your utilization low. And those are the two most significant factors on a credit score itself.
Yeah, like, repayment history is, obviously what's your track record in repayment. But if you're somebody who's using as much credit as you have available to you, does that signal financial distress or that you're spending money that you shouldn't? Which also goes back to the first.
It depends on how it all works out. I mean, there's so many nuances in regards to that because there are people that will pay, but provided you keep the report that says the final report that comes in at a lower amount, if it says that you are now carrying over 1,000 on a 10,000, that's only 10%, so that's still good. So there's a lot of nuances in regards to how it's reported, and I do want to sort of re-emphasize this is the interesting part from an Equifax perspective. But I just want to advise you, we are a reporting agency. So, a lot of people say, oh, Equifax is killing my score, doing whatever. No, all we do is we actually accept all the information from all the lenders, consolidate it, and then we basically bring it back out there. So what does that mean? We don't, it's not like, oh, Rob, I don't like Rob, so I'm going to lower his score. Like I don't have any power to do so. It really is just everything that's reported accordingly gets reflected back. If there's an issue, an error, absolutely, we're not averse to fixing it because we want it to be accurate, but we have to work through the lending institution that basically reported it to us, get them to fix it, have it resolved, and then put it back into the credit file itself. So just a reminder that we will do our best to have accurate files, but really we are just a reporting agency. We don't make specific judgments on anybody.
Yeah, no, you're a data collection agency and reporting agency. Yeah. That's awesome.
Okay, very interesting. At the start, you mentioned that Equifax's revenue is around $12 billion. What's the breakdown between like products who some of your top clients would be? Like, where's the revenue for?
You know what? I will pass, and then you might want to edit this out. But I couldn't say specifically. Okay. So I can't say specifically, but I will tell you in a higher level. I mean, really, one of the biggest things that we've had to, mostly over the years, it's evolving. Our revenues are evolving more towards the analytics and a lot more towards fraud. Fraud is becoming so significant that maybe even a third of our revenue comes from fraud. But traditionally, it was really the traditional credit file. Because remember, beyond adjudicating for someone net new, a lot of Equifax's job is really helping these lenders, credit card companies, big brother you, basically. Essentially, all these entities buy your credit file every month. So if you can think about every credit card that's out there, every transaction, every loan, they're basically pulling another credit file every month on you individually. So that is really where a lot of the revenue does come from Equifax. It's just a traditional account, what we call account management. Just keeping an eye on somebody and deciding whether we give them another credit card or raise their limit. That's all done, through basically a lot of analytics through the year. It's not just done on a whim. It's not like, a bank decides, hey, let's just give a bunch of people some credit. They've been analyzing their whole portfolio and then making a decision. And through that account management is where a sizable amount of Equifax revenue does come from.
Interesting. I know I use a free app. I think it's called Credit Karma. How does that, and I notice the score changes, versus Credit Karma whenever I do a hard pull. Would you recommend clients who are just looking to stay on top of their credit score some best practices?
Yeah. Well, you actually, and I'm glad you reminded me, you actually identified one more myth.
Perfect.
And the myth is there is no standard score in the world. There's no standard score in Canada, North America. So the predicament with a lot of consumers is they get fixated on a score wherever they get it, Credit Karma, Equifax, whatever, and they just believe that everybody else is working from that score. And that's not the case. I know of at least 30 different scores in Canada, including the customized ones with the banks as well. So what ends up happening is when I work with a lot of brokers, it's all about education. It's about having the brokers be able to explain to customers that, hey, depending on what you're buying, depending on what kind of customer or lender that we're working with, some lenders, A lenders have a different score. B lenders will use a different score. Or if you're selling credit cards versus houses, they use different scores because the models work differently. What we ultimately have to advise our brokers as well as the consumers is, at the end of the day, there's many scores out there, but it's the score that your lender is looking at is the score that they're going to adjudicate on. You could bring all the scores in the world, it doesn't matter. So we're very fortunate in the Canadian broker world that we do use what we call a FICO 8 score by Equifax. So that's a good thing because there's consistency between the broker to the lender to the mortgage insurers. So that is a good thing that there's consistency across all the different entities. But bear in mind, the unfortunate thing is consumers can't get a FICO score because FICO, Fair Isaac Company, doesn't sell directly to consumers. So in most cases, this is where the challenge comes in. You're a customer getting your score from Credit Karma or Borrowwell or what be the case, or even your bank, and then you're trying to take that score and transpose it into the world of brokers and say, hey, this is my score, get me a deal with these guys because they take my score of 680. Well, when they look up your FICO score, maybe it's 670, doesn't qualify. So that's the big challenge we have is, or the myth that we have to break with customers is, there is no standard score. The score that's gold is the one that your lender's looking at that's trying to adjudicate for your mortgage or auto or what be the case.
Did not know that.
Yep. There's different algorithms. Mm-hmm. Sometimes the consumer ones are a little bit more flattering than what the broker and lender reports might say. I've seen TransUnion reports that didn't align with Equifax
so from an
reports
Equifax
that didn't align with
yeah,
Borrowwell.
Here's my answer to that. People are always asking for what, it depends on the agenda you have. Brokers are asking, what's my highest, where can I find the highest score? Lenders are going, where's my lowest score? There's a whole agenda because you know what? It depends on what you're trying to get at. All we can say from an Equifax perspective is we try to provide the most accurate score. Remember I said earlier, you basically dig the grave that you're in. That's what you have. Here's the most accurate score. Buy accordingly because it's appropriate. Don't look for the highest score. Don't look for the lowest score. Look for the most accurate score because that's really, where you want to be as far as be it the lender or the consumer. You want to really not overextend yourself either. I mean, you're only asking for trouble unless you get fortunate and you inherit something.
Yep. Objective data collecting and reporting. That's all I'm hearing.
Yeah.
That's as best as we can do. Yeah, absolutely.
I love it. Very good stuff. Anything we didn't touch on that you think would be valuable insights? Because I think we touched on pretty much everything we wanted to go over. But if you think we missed anything that you think would be of value?
Well, I mean, the only thing and as I mentioned earlier, one of the things that's really becoming more prominent is really about protecting yourself. It's really about fraud and identity theft because it's unfortunate. During COVID, we started to see a surge of, fraud online. And why did that happen? Well, because we put all our parents and grandparents online. And we made them buy stuff online, and they really not screwed up, but they really got into something where they started to basically open themselves up, and there was a lot of fraudsters that occurred, and that hasn't slowed down. So from an Equifax perspective, a couple of things we did. We made credit files online available to consumers. So one thing I do want to express to people that, for the last couple of years, if you go to equifax.ca and you go to the personal tab, you can actually pull your own file and credit score for yourself online. Why do I suggest this? I actually suggest to people you should at least do it once every 6 months. Reason being, you want to make sure it's accurate, but at the same time, you also want to make sure that nobody is starting to steal your identity. In the older days, how did we steal identity? I found Rob's wallet on the ground and I spent like hell until he canceled all his cards. Today, fraudsters are much more complex. They're much more intelligent, much more patient. They will actually mature and they'll take care of someone's credit identity. They'll actually build it up, under their name or under their pretense. But at some point in time, what they'll do is they'll cash it all out, access maybe $50,000 worth of assets in one way, shape, or form or another, disappear, and then Rob will end up with $50,000 worth of bills that are not being paid, and all the banks and everybody are coming after him. So by monitoring your credit file every 6 months, the very least is you're kind of keeping an eye on making sure everything is yours, so that nothing is, somebody trying to steal your identity and so forth. And I joke with people, but I say, here's the reality. If Rob comes to the banks and says, hey, I think somebody's stealing my identity, they'll be much more forgiving than 6 months from now when the banks come to Rob and say, give me my $20,000. So it's a different sort of mentality. So it's better to be proactive and look at your credit file than it is to wait for that stuff to happen. Because in Canada, US, it's inevitably going to happen to everybody. It's one of those not if, but when. So you might as well start being prepared. And credit is really a good help for you in regards to trying to at least reduce fraud as much as possible or identity theft.
Awesome. And what about if somebody ever had to contest something that's on their credit report? Because that's one of the things that I see a lot. I paid this, I paid this cell phone bill. I paid Enbridge. I paid Enmax. Eric, why is this collection showing on my report? How do I contest that?
So absolutely, we have a dispute process online for consumers. They can absolutely open up a dispute process because ultimately Equifax reports to the Privacy Commissioner in Canada.
Right.
And they're always asking us, is this accurate? It is a challenge. So absolutely, when somebody has a discrepancy, we certainly want to investigate it, open up a dispute. But we will say that you got to kind of give us proof. Just because you say, I've never had this credit card is not necessarily sufficient from our perspective. We have to have proof in regards to what's going on and what's happened. If you paid something, if you have proof accordingly. And remember, again, we're a reporting agency, so we'll be sort of the ombudsman between you. If you say you paid a Canadian Tire bill and you have proof, by providing it to Equifax, we will go directly to Canadian Tire, show them the proof, get them to fix the reports, and then have that reflected back on the credit file. And over and above that, just as a little side note for brokers out there as well, or in case, investors don't know that your real estate broker or your brokers out there have what we call an escalation process also with Equifax, where they can actually escalate an investigation as well. Why? Because, we recognize that every time there's an error on a credit file in the mortgage broker space, potentially there's a house on the line, and it's a fairly substantial risk. So we actually created an escalation process for brokers out there in case they want to help their consumers fix their credit files to be able to get a deal or what be the case.
Cool.
Yeah.
Perfect. Yeah, I think we covered literally everything that we wanted to go over. I got a lot of value out of this.
Yeah, I loved, from two guys knocking on doors to talking about how we can work at the tenant issue to mitigating fraud to maintaining credit health to different algorithms to utilization and everything in between. This has been a really cool conversation, Eric. We really appreciate your time.
Oh, you're welcome. I appreciate it. And again, my goal is always about education. The more people that are educated, the better, the health of everyone. Credit health, that is, financial health. But I appreciate the opportunity, Ryan and Rob.
Awesome. And lastly, if anybody wants to learn about credit, where should they go and what should they click on?
I highly advise Equifax.ca to start with because we've improved the website substantially over the last 2 or 3 years. Includes tutorials, includes webinar, video. There's a substantial amount of different types of ways to educate people. So definitely Equifax.ca. But notwithstanding, even the Credit Karmas of the world, the Borrowells, all of them have education sites themselves. So please, the key thing is go to the main sites, learn about it. But certainly if you want to be more concerned about what Equifax is talking or thinking about, just come to our site, Equifax.ca, and there's a lot of information there as far as, improving your credit information or knowledge of credit information.
Perfect.
Awesome. Thanks for the time. Really appreciate it, Eric.
Great. Thank you, gentlemen, and have a great rest of the day.
You too. Cheers.
Take care.
That wraps up another episode of the Real Estate and Wealth Podcast. Be sure to hit that like button, share with fellow real estate enthusiasts, and subscribe to stay in the loop on all upcoming episodes. Get in touch with the team at Calvert Home Mortgage Investment Corporation by calling them at 1-888-752-4642 or email admin@chmic.ca. The opinions expressed in each episode belong to the individuals featured and do not represent the views of Calvert Home Mortgage. While we provide valuable insights, consulting with qualified professionals ensures that your unique financial circumstances are carefully considered, aligning your investments with your long-term objectives. Calvert Home Mortgage Investment Corporation is not a financial advisor, and we cannot advise you on making investments. There are risks to investing in real estate and the potential that you can lose all of your investment.